This is the Asia Trade. I'm Shery in Tokyo.
And I'm Haidi Stroud-Watts in Sydney. The top stories this hour. Asian stocks are poised to extend a rebound after US benchmarks wiped out this year's losses. Risk sentiment boosted by a cooling trade war and a surprisingly positive earnings season. Treasury is giving up gains spurred by soft US inflation data, with a shift to equities reinforcing a view that Fed rate cuts are unlikely before December. And President Trump touting $1 trillion of Saudi investment at a glitzy event in Riyadh, but the figure doesn't stand up to scrutiny.
Take a look at how we're setting up in the Asian trading session. We're seeing a little bit of downside pressure for Nikkei futures, but this, of course, after already 4 sessions of gains for the Japanese stock market. When it comes to Sydney futures right now, upside of 0.2%. We continue to follow all of the earnings season today, so we'll be watching really the impact on SoftBank as well, with its profit more than doubling. And of course, we also have earnings out of Sony as well later today. And you can see that in South Korea, we just got the adjusted jobless rate coming in at 2.7%, which is below what economists had expected. In fact, 194,000 jobs were added in April from a year earlier. And this, of course, despite all of the uncertainty over domestic politics, not to mention the tariff impact as well. That uncertainty around trade tensions, around tariffs, that has really changed into more optimism. We saw another rally in the U.S. session. Take a look at how futures, of course, are setting up right now. We saw those gains in chip makers. We do have President Trump in the Middle East. And of course, he came out with some goodies coming from Saudi Arabia as well. We'll be watching the energy sector as well. We understand that an energy critical minerals deal was also struck on that front. Nasdaq 100 futures right now not doing much, but of course we had chipmakers soaring after that report that Nvidia and AMD would get some more sales coming from Saudi Arabia. Haidi.
Yeah, and as you mentioned, the goodies that we're scrutinising, right? President Trump and the Saudi Crown Prince Mohammed bin Salman have announced big investment pledges at the summit in Riyadh, although the exact value of the deals isn't clear. Let's bring in our Bloomberg News editor, John Harney. John, great to have you with us. And so, you know, we kind of want to dig into the specifics, right? Does a deal stand up when it comes to the claims?
In any case, this was very much Donald Trump, the consummate deal maker, presiding at this high-profile summit in Riyadh. Now, as you say, he said that the Saudis would invest as much as $1 trillion in the United States over an undetermined amount of time, but signs at this very event put the figure much lower at about $300 billion, and the White House later said it would be in the range of $600 billion. Now, $1 trillion is more or about the entire Saudi GNP, and that's at a time when oil prices are about more than $30 lower than what the kingdom needs to balance its budget.
We also saw that perhaps there would be some energy or critical minerals deals. Do we have any more idea of what's next for the relationship between President Trump and, of course, Mohammed bin Salman, the crown prince who's gained real footing in the kingdom?
Critical minerals, we'll have to see, but certainly business was being done in Riyadh. There was $142 billion announced in defense contracts, sales to the Saudis. Nvidia and Advanced Microsystems will be selling chips to a Saudi AI company. And there's also another major deal involving a Saudi healthcare company, which would invest in the United States. So certainly there was plenty of reasons for all of these top American executives to be in Riyadh along with the president.
And so much of this has been the floodgate of deals when it comes to Nvidia, right? What was sort of achieved when it comes to the tech space?
Well, one thing that was achieved was that restrictions on chips that were put in place by the Biden administration are about to be lifted. Now, the Commerce Department announced this while the president just happened to be in Saudi Arabia. Nvidia and Oracle and other companies had long chafed at these restrictions that said that it prevented them it interfered with their business plan. So it was certainly a pretty good day for the tech industry, the chip industry, here in the United States.
Bloomberg News editor John Hardy there with the latest on President Trump's trip to the Middle East. Now, China is said to have removed a month-long ban on airlines taking delivery of Boeing planes. This, of course, follows that temporary truce struck between the U.S. and China. For more, let's bring in the executive editor for the Greater China region, John Liu. John, what have we heard about what could happen to these Boeing deliveries? Of course, this has also been a point of friction between the two countries.
Well, so since we've had that agreement in Geneva, we've been waiting for this news. Of course, China and the United States, as part of that agreement, China agreed to remove its non-tariff barriers that have been imposed since April the 2nd, since Liberation Day. This was one of those non-tariff barriers. China asked its airlines to stop taking Boeing deliveries as a result of those tariffs put on by the United States. It seems now, as we understand, the government has told Chinese carriers they can again start taking those deliveries. That'll be a boon for Boeing. They have about 50 planes they're hoping to deliver to Chinese customers this year. Without those customers, Boeing could have sold those planes to other carriers around the world. There were some in India, Malaysia, other countries that expressed interest. But these planes are so customized, it would have been a pain. There would have been an additional cost. And so this is, again, one sign of how business is getting back on track after the agreements reached in Geneva.
John, even as we see this de-escalation between China and the US, it's certainly not stopping the diplomatic overtures being made to other partners, right? If you take a look at the agreements and the narrative being struck between Xi and Lula, this pursuit of the global South and supremacy in that space continues.
Exactly. The Trump administration, the tariffs, that's obviously posed lots of challenges for the Chinese government, especially when it comes to trade and the economy. But at the same time, it's opened up a diplomatic window, as you might say. And one of those places where it's opened up an opportunity for China is in Latin America. We had this gathering of leaders, the president of Brazil, the president of Colombia, the president of Chile. They were all in Beijing this week for this community of Latin American countries and Caribbean states. It's a great opportunity, and the relationship that Brazil, for example, has with China is quite different from the one that the United States has. Brazil runs a trade surplus with China. The two economies are they're a good match. China imports a lot of agricultural goods, beef, and in turn, it invests in Brazil. It's building a railway to the Pacific Ocean. BYD, other Chinese companies are investing in building factories in Brazil.
How successful have these sorts of economic soft power efforts been, given that it's gotten sort of more difficult for China to invest outwards as its domestic economy struggles?
I think it'll take some time before we know how these efforts what they'll deliver in terms of economics. But I think obviously, or more pronounced, is the fact that China has portrayed itself as being the responsible actor on the global stage. And over the course of the last few months, with the various tariffs that have been put in place by Washington, D.C., that has made China appear like the more responsible partner for lots of countries around the world. And that could lead to further opportunities for Beijing in Latin America and Europe and other parts of the globe.
John, what are we expecting when it comes to the next stage of negotiations between the U.S. and China? Do we have a timeline for when they will meet next? And given that this is just a temporary truce of 90 days, what could come next?
Well, we know that Secretary Scott Bessent has said there will be meetings in the next few weeks. The United States and China have agreed that those meetings will either take place in China, in the U.S., or in a third country. There is a 90-day pause, and so I would have to imagine there's going to be lots of negotiations and diplomacy during that period. The number one thing I think right now for both countries is trying to find a way to unwind the tariffs that were put in place by the United States because of fentanyl. And there was already a separate discussion in Geneva between the security officials from both countries. And so if that were to find some solution, you could take those fentanyl tariffs off. That would be an additional boon for trade between the two countries. I would suspect also that if in 90 days there's not an additional deal reached, there's going to be a lot of motivation to extend, to push further down the road, because nobody on either side wants to see those tariffs go back up.
Bloomberg's John Liu there. Coming up on the Asia trade, we get more on President Trump's visit to the Middle East with Johns Hopkins University. We'll be live at the Macquarie Asia conference too to talk through what opportunities the investment bank sees across the region. We're speaking about robotaxis in an exclusive with Pony.ai. Much more ahead. This is Bloomberg.
U.S. inflation rose by less than forecast in April, suggesting little urgency among companies to pass along the cost of higher tariffs to consumers. Bloomberg opinion columnist and senior editor for Markets, John Authors, joins us now. John, is the U.S. economy out of the woods, or is this just a blip in the inflation data print?
I don't think the U.S. economy is out of the woods. The problem is that so many of the economic factors driven by the tariffs, by people knowing that they're coming, mean that you need to be extra specially careful with the data. Companies brought a lot of their purchases forward because they knew tariffs were likely. It's perfectly possible that the reason this month's print was as good as it was is because they've still got plenty of inventory on hand that was bought before the tariffs came in, and so they don't have the dilemma yet of how much to pass on to consumers. In general, it was a thoroughly good inflation report as far as the Federal Reserve is concerned. It could maybe have come down a little bit quicker, but that's always the case. All the main measures that they're most worried about at the moment fell, most noticeably what they call super core inflation, which is services including shelter. So it certainly is a sign that the US economy was in pretty good shape before we had the Great Liberation Day shock administered to it.
John, you wrote about the news on the de-escalation between the US and China being, what dreams are made of. And later on in your piece, you kind of call into question, does this mean we can just pretend that this entire episode never happened?
Yes. Well, the analogy which any viewers who, like me, had their childhood in the 70s and the 80s might remember this, but there was a soap opera called Dallas where Bobby Ewing, one of the main lead characters, gets killed off at the end of one season. He's dead for the whole of the next season, and then they realized they really wanted to write him back in. So they decided that whole season was just a dream in the mind of his wife, and he comes back. So you can ignore an entire season, and that is known in markets as the Bobby Ewing test. Does the climb down on Chinese tariffs mean that we can just ignore everything that happened between Liberation Day and this last weekend in the same way that we could ignore the season of Dallas without Bobby? And it's tempting to say that we really can go that far, that this was just one aberration. Markets are back. Most of the key markets people watch are back where they were in early April, and we can all forget about it. I kind of doubt that because the impact on trust remains the fact that so many fund managers have been thinking the previously unthinkable about, well, can we rely on the US? Should we be having less exposure to them? The fact that other countries are doing their own thing about expanding fiscally to deal with the potential for tariffs. I don't think we're talking about the one-off self-induced recession that we were for a few weeks, but I don't think this is exactly as if Donald Trump had never mentioned the word tariff. We do need to. It's not like the populist season of Dallas.
Dallas sounds very much like any other K-drama or Mexican telenovelas at this point, but...
That's probably true, yes.
Right? Talking about fiscal expansion, how about the tax cuts that could come from the GOP? Multi-trillion-dollar worth of tax cuts. I mean, how much does that boost the economy, but also really potentially threaten more inflation?
It was interesting that Bank of America put out their monthly fund management survey of global fund managers today. And I think it was 2% of them thought that the deficit was going to come down as a result of whatever emerges from the tax and budget discussion. So plainly, nobody thinks they're really going to tighten fiscally. And if that were to happen, I don't think it's going to happen either. If it were to happen, that would be a big negative shock. I think when it comes to what is coming down the pipe, you've got to remember that it's quite difficult to stimulate with tax cuts because Congress has to work out a way just to keep taxes where they are. The Trump 1.0 tax cuts are due to be removed shortly. And you also have the problem that bond yields, while they haven't broken out decisively above 5% for the 10-year Treasury, are uncomfortably high and plainly nervous about anything that will require even higher supply of Treasuries. This is where the kind of damage to trust that might have been done during the tariff kerfuffle of the last few weeks begins to be relevant. There probably will be somewhat less demand for Treasuries from foreign investors at the margin anyway. And if the US decides to be, on balance, fiscally irresponsible, increase their deficit, increase the amount they need to borrow, this is unlikely to be a good time to try to do that. So I don't myself see much real stimulus from the macro level coming through for the US economy. US corporate sector is another story. There could be a lot of reasons why they continue to flourish, but I don't myself see big stimulus coming for the US economy that we'll notice and feel this year.
Yeah, John, I was going to ask you, how cheered are you by sort of the nascent signs of optimism from earnings so far?
Again, the earnings season, I'm as guilty of this as anyone else. The tariffs were so exciting and so hard ever to put out of your mind that I probably didn't cover the earnings season as well as I should have done. US companies are still making really big profit margins. And I think one of the more interesting things, which again, it was quite easy to lose amid all the noise this week, was Monday's announcement from the White House on clamping down on the drug makers. The response was that most drug makers companies stocks actually went up. So this is one of the risks that was out there as of a populist turn, a populist anti-corporate turn by the administration that would clamp down on profits. And you can certainly argue drugs companies in this country make more profits than is good for them. And it looks as though, at the moment, the market is thinking that's not going to happen. The one point I would make that is some more of a cause for concern about earnings is that you saw projections for the full year decline more than they normally would. And this is, again, one of the infuriating things about the noise surrounding tariffs. Most companies were announcing when the tariff rate on China was still 145%. So everybody assumed that it couldn't possibly stay that high for very long. Most people probably assumed that it would come to rest at a level higher than the 30% where it is now. So maybe we shouldn't wholly trust the relative bearishness we heard from managers for the whole of the year, but that's the one point I would caution about the earnings season, was that they could have been and would normally have been more positive than they were for the immediate future.
John Authors, our Bloomberg opinion columnist and senior editor for markets. We have much more ahead on the Asia trade. This is Bloomberg.
You're watching the Asia trade. These are the latest from the corporate front. Microsoft is planning to axe about 6,000 jobs to reduce management layers. The company says the cuts amount to less than 3% of total headcount, including LinkedIn. About 2,000 workers will be impacted at Microsoft's headquarters in Washington, with terminations expected to start from mid-July. Hundreds of Starbucks workers have walked off the job since Sunday to protest a new dress code, with their union promising more strikes to come. Starbucks Workers United represents staff at about 570 of the 10,000 company-run U.S. stores. It's filed a complaint saying a dress code change during contract talks are unlawful. Starbucks says there's no significant impact to operations. Disney has announced that its ESPN sports streaming platform will cost $30 a month. The product is set to launch later this year, offering access to live events, on-demand replays, and original programming. Disney will also offer ESPN as part of a bundle with Hulu and Disney Plus for $36 a month in a bid to attract more subscribers. Jaguar Land Rover has joined other car makers in withholding profit guidance due to uncertainty caused by President Trump's tariffs. The British auto giant owned by India's Tata Motors says it's evaluating the impact of global challenges and will provide an update during next month's Investor Day. The company does not have any U.S. factories.
Shery, take a look at the setup as we are just about half an hour or so away from the start of cash trading here in Sydney, as well as Japan and some of these other major markets coming online. And we are broadly expecting stocks in Asia to extend the week's rebound. We saw US benchmarks overnight wiping out the year's losses on these signs that we see the de-escalation in the trade war, inflation data also showing a pretty muted impact of the tariffs in place so far. But of course, a big question mark as to the pushing back of these expectations for Fed easing. Sydney futures looking like we're higher by about 0.25%, a little bit more muted when it comes to Japan, though.
Yeah, take a look at how currencies are trading as well, because that optimism that we saw in U.S. assets, especially with the huge rebound in the U.S. dollar, might have faded a little bit. Overnight, it fell. Traders sort of doubting perhaps the durability of the surge. We did get the temporary U.S.-China trade truce, but at the same time, dollar bearish bets so far this week are more than the value of bullish trades. You can see the Japanese yen holding at that 148 level. The offshore yuan also not doing much right now. This is Bloomberg.
President Trump and Saudi Crown Prince Mohammed bin Salman have touted $1 trillion in commercial deals after meeting in Riyadh, but the actual value of those agreements may be in dispute. Meanwhile, Nvidia and AMD will supply chips to Saudi Arabian AI company Au-Yeung for a massive data center project. And Elon Musk says Saudi Arabia will authorize Starlink for aviation and maritime shipping. Let's get more on Trump's Middle East trip with Randa, who's a fellow at Johns Hopkins University's Foreign Policy Institute. Randa, great to have you with us. And so certainly there is a flurry of what is being sort of perceived as deliverables, both monetary, some of these sort of restrictions as well being eased. What do you make of the achievements so far, given that there is sort of a little bit of head scratching over how that amount came to be?
Yes, I mean, part of it maybe is all commitments that is being repackaged. Part of it is new commitment and new deliverables. But also we have seen that happen in the past when President Trump went to Saudi Arabia in 2017. Agreements were struck at the time. Many of them were not eventually implemented. So at this point in time, I think the number is big, and it will have resonance in the United States domestically. And I think that's what matters for Mr. Trump at this point in time. And for the Saudi leadership, I think it certifies or anchors their position as a regional leader.
The policy speech that he made was quite interesting, although perhaps not unsurprising. It was very transactional in nature, right? Make deals with us and we won't push back when it comes to things like human rights.
Yes, I mean, look, the policy speech had also some resonance in the region. And the part that really was very well received is when he was talking about Western interventionists in the past that have tried to rebuild countries in the region and that have failed. And that he basically, President Trump said, it's you people of the region know how to build this. And this is something that is now a big theme in the Middle East. It's a region now that feels it has agency, it has leadership, it has the resources, and it's trying to get its act together and is not looking for conflict, and as much as possible is interested in partnerships with the United States, but also equally partnership with China. And that's, I think, what's going to resonate is that if Mr. Trump came to the Middle East with the hope that he can push China out, I think he will be disappointed, because the region, especially the regional leaders, are interested now and see their interest lying in balancing between the two powers rather than in allying with one power.
That's the thing, right? I mean, when leaders go into these summits, even if they have a very amicable, collaborating relationship, they both want something out of it. MBS seems to have gotten a stage to showcase his power as the heir to King Salman. What did President Trump actually get, and who ended up actually with the upper hand in this relationship?
What President Trump got is the billions of dollars that they say they have, in terms of investments in the United States. Again, whether these will come true or will be implemented, or most of them maybe will be implemented and some will not, time will tell. I think that's what he got from it. Again, he is trying to, he has a broader Middle East strategy, which interestingly, the countries of the Gulf seem to be more in sync with Trump's broader Middle East strategy than, for example, our close ally, Israel. They are very much for a deal with Iran. They are very much for de-escalating conflict dynamics in the region. And they are very much interested, like Trump, in business, in economics. They have visions for their countries, and they would like to see the region enter some kind of stability away from conflict in order to realize these visions.
President Trump, though, has never had that much interest in giving, say, Palestinians a sovereign state. How will the situation in Gaza play into the dynamics between the United States, the Middle East, and Israel?
It's interesting that not much was talked during the trip, unlike, for example, previous trip by President Biden about normalization between Saudi Arabia and Israel. And I think the Saudis have let the American leadership know that as long as there is a Gaza war, as long as the Israeli leadership is not interested in serious discussions about a pathway to a Palestinian state, they are not going to be interested in normalizing relations with Israel. And so I think this is going to remain a point of divergence, let's put it this way, between the United States and most of the countries in the region. And that's going, and there will be, and I'm pretty sure President Trump heard from MBS, but also he's going to hear from the Emirati leadership as well as from the Qatari leadership, the importance of bringing the conflict in Gaza to an end quickly, and the importance of getting Israel to move onto a path toward Palestinian statehood.
When it comes to the economic challenges domestically for the region, how much does that curtail the ability to kind of increase the transactional appeal of dealing with the US?
Yes, I mean, Saudi Arabia is suffering from budget deficits. I mean, they have a lot of money already committed to domestic investments, some of which have had to be curtailed, like the NEOM project recently. And so I think, again, it speaks to whether these billions of dollars of commitments that were made between the United States and Saudi Arabia will be fulfilled in the end, given the domestic priorities and given the fact that, you know, the price of oil is low compared to previously. And so that's going to curtail also the ability of Saudi Arabia to put more funding and divert funding more toward investments in the U.S. Right now, their priority is investments in Saudi Arabia. And they have already invested quite a lot in the United States in terms of treasury bonds and money given for investment to Mr. Kushner. But I think going forward, there will be certain limits on how much they can put more into the United States in terms of investments.
Randa, fellow at Johns Hopkins University. Right, and other stories that we're following at the moment, President Trump also says that he will lift U.S. sanctions against Syria following the toppling of former President Bashar al-Assad. The move will provide a significant boost for Syria's new president, whose Islamist rebel group overthrew Assad's regime in December. Trump says his recent discussions with Saudi's crown prince and Turkey's president persuaded him to make the move. Israeli Prime Minister Benjamin Netanyahu says he's days away from ordering an all-out escalation of Israel's war against Hamas. Netanyahu says his armed forces are preparing to, quote, finish the job after 19 months of attacks on Gaza. Hamas this week released the last surviving U.S.-Israeli hostage, but still holds 58 Israelis, with fewer than half believed to be alive. India has proposed levies on some U.S. goods in response to Washington's duties on steel and aluminum. The Modi government told the World Trade Organization the U.S. metals tariffs adversely impact India's trade, and it has a right to suspend concessions as a countermeasure. This marks India's first retaliatory action against President Trump's tariff regime and comes as the two countries negotiate a trade deal. Former U.S. Ambassador to China Nick Burns thinks the trade war between Washington and Beijing is nowhere close to coming to an end. Speaking to Bloomberg, Burns says the root of the current tensions lies in China's trade policies.
Well, first of all, I start from a first principle, and that is that China's been the largest and most important disruptor in the global trade system for about 3 decades right now. There's a reason why the United States and many other countries around the world have placed tariffs on China. China's manufactured exports in particular is because China's been dumping them around the world below the cost of production. And it's been a killer for jobs, both in the United States historically in the last several decades, but also around the world. You have a situation now where Turkey and India and Brazil and Colombia and Mexico and Canada and the United States and the European Union have all put tariffs on China. So I have a degree of sympathy for the situation that President Trump and his team inherited, which was a situation that we left when I left in mid-January as ambassador to China. President Biden, a year ago, May 2024, placed 100% tariffs on Chinese EVs, 50% on semiconductors, 25% on lithium batteries. So the root of this problem is China and Chinese trade policy. The Chinese are trying to act now. You saw it in the statements over the weekend from Vice Premier He Lifeng, is that they're the innocent party, that they are the victim of this trade war by President Trump, when in fact, and that they're the responsible party, when in fact the reality is quite different. I think it's important to set the stage. Having said that, these are going to be very, very difficult negotiations.
During your tenure, you were trying to, if I may, rehabilitate a relationship that had worsened during the first Trump administration. Develop conduits for communication, reestablish economic and security ties. When you left that post, could you have envisioned this turning out the way that it has, in terms of how the rhetoric has been ratcheted up, the tariffs that have been put in place? Is it the worst case that you envisioned, or worse yet still?
I certainly did not anticipate 145% American tariffs on China or 125% Chinese tariffs on American goods. And the trade war that has resulted effectively led to a trade embargo as of the past week, when no ships were sailing with goods back and forth, when manufacturers couldn't export to each other's countries, and you see the significant shortage of goods that traditionally are important to both economies. I didn't expect that to happen at all. And that's the most important thing happening in the global economy right now, which is another reason I think that eventually both sides have to agree to a deal to calm global markets. We're the two largest global economies, so we have a profound impact on the health of the global economy, but we also need the global economy to be functioning in a rational and stable way. There's so much at stake. I didn't see that happening. I think few people saw that happening. You remember candidate Trump pledged 60% tariffs on Chinese goods, and people thought that would be a revolution. Well, 145 was a revolution of a different magnitude. And I think, we're not anywhere close to being out of the woods.
That was Nick Burns, the former US ambassador to China, there speaking to Bloomberg's David Gura. Let's take a look at how commodities are trading at the moment, particularly in light of the suite of really geopolitical developments in the Middle East. Oil steadying. We saw the biggest four-day rally since October, really being driven by some of that trade war enthusiasm, the sort of hostile rhetoric that's increasingly being built upon Iranian supply there as well. He said during that visit, President Trump, that is, that the US will exert maximum pressure on Iranian energy exports if a deal isn't reached on the nuclear program. So we're seeing crude sort of just trading sideways after a pretty big rally over the last 4 days. Iron ore, seeing it pick up there, a little bit of China enthusiasm no doubt at play, and that's a picture when it comes to gold. Of course, it has rallied so hard so far this year when it comes to that risk-off haven demand story, but still the rebound is being driven by a slightly lower dollar there following that softer US CPI print. Coming up next, SoftBank reports profit that soared 124% in a boost to the firm's aggressive data center investment plans. More ahead. This is Bloomberg.
As part of Nissan, we need to implement further workforce optimization, primarily driven by our planned consolidation efforts.
Right, that was Nissan's new CEO, Ivan Espinosa, speaking to investors after the company reported a full-year net loss of $4.5 billion, its biggest annual loss in 25 years. Nissan is accelerating its restructuring plans after those results by closing 7 factories and cutting 20,000 jobs. Let's bring in our automotive reporter, Nick Takahashi. Nick, so how is this restructuring plan different from what they've tried in the past?
So what we saw from Ivan Espinosa yesterday, it was his first earnings call actually since becoming CEO in early April. It was a big departure from what the plan was in around November from his predecessor, Makoto Uchida. The original plan was to cut 9,000 jobs and slash production capacity by 20%, and Ivan wrapped that up by making it 20,000 and promising to cut 7 plants globally. The job cuts include domestic employees as well. And so what we saw was an acceleration of Nissan's restructuring, and in a couple minutes we're going to see the market open and see whether shareholders are convinced by that. But I think the main criticism now is going to be whether it's too little too late.
The narrative this season really are looking at the impact on global car makers from the cost of Trump tariffs, right? Is the story any different when it comes to Honda?
The story's sort of on the other side of the coin when it comes to Honda, because when it came to the tie-up between Nissan and Honda that was signed in December, it was Nissan that needed a lifeline, but Honda that was seeking scale to compete with some of the world's biggest car makers, especially in the advent of electric vehicles. But now that partnership has formally ended, Honda is still in the throes of a burgeoning trade war with Trump's U.S. tariffs on imported cars and parts, and that's going to hurt their bottom line, along with pretty much all other Japanese car makers.
Right. Nick Takahashi, Bloomberg automotive reporter, here with of course, a preview of the market opens, and we'll be watching that stock, Nissan and Honda as well. These are some of the other stocks that we'll be watching as well, because we got earnings from Sony, and we actually saw their profit more than doubling. We're talking about soaring 124%. We have seen increased valuations of tech startups like ByteDance and Didi, and we're talking about SoftBank, in fact, which we'll be watching for the market opens because of the profit soaring. But for Sony shares, also, we have seen that they have gained more than 10% this year. We are expecting earnings today. We will be watching for an update on their capital-intensive strategy of pouring investments into acquiring more content and how that's faring. We'll also get Sumitomo Mitsui earnings later today, likely to see another record year. Of course, we have seen really net income getting a boost from the BOJ's normalization policy. We'll also be watching Rakuten, where we get earnings later today. And as I mentioned, SoftBank is the one that we'll be watching because the profit soared, resilient demand for AI, jump in the value of their investments in startups. Not to mention that the earnings jump is a boost for SoftBank's aggressive data center investment plans.
Shery, we're also watching Macquarie on account of some of these regulatory developments, right? Australia's markets regulator suing Macquarie Securities, alleging that the firm misreported millions of short sales for more than 14 years. The allegations are to do with events taking place between December 2009 and February 2024, saying that Macquarie Securities failed to correctly report the volume of short sales by at least 73 million, according to that statement. Macquarie hasn't responded to a request for comment yet, but earlier this month we did see ASIC demanding improvements at the bank after repeated compliance failures within its futures business that were related to the misreporting of trades, so calling these multiple systems related issues with this misleading conduct allegations. More ahead on the Asia trade, this is Bloomberg.
We have factory inflation data out of Japan when it comes to the year-on-year number decelerating from the previous month, coming in at growth of 4%. The previous month was also revised upwards to 4.3%. Month-on-month, missing economists' expectations, that growing only 0.2%, Haidi.
Shery, UBS Global Wealth Management says its high net worth clients are increasingly shifting away from US dollar assets, turning instead to gold, crypto and investments in China. The Asia chairman, Amy Low, told us why a diverse portfolio is key to navigating rocky markets.
I think one thing for sure is volatility is definitely here to stay, and uncertainty as well, despite the fact that actually, generally, the market reacted quite positively, and the temporary solution came a bit earlier than expected. And we've been talking a lot to clients lately, and so clearly, clients are looking for diversification, looking for advice. I remember I just came back from a few business trips, and in some of the meetings, in one of the meetings, we have 12. The client bought, because 70% of our clients are entrepreneurs, so definitely it has a lot of impact to both their business and also to their investment. So in that particular meeting, he brought along the family office, the whole family office, the CFO, the strategy planning, and the question will be around, what should I do with my investment? How am I going to diversify my business? So I think clearly it has an impact.
You were in Taiwan, right, during that historic surge? What was it on the ground? What was it like among some of the clients that you talked to?
I was there when the NTD went up so much. And obviously, as I said, from the client point of view, they are also looking, because Taiwan primarily is a very export-led kind of economy, despite the fact that the tech sector is also quite strong. So we have a lot of discussion on how we going to help them and support them in diversifying their business. And there are also a lot of M&A opportunity. To be honest, right now we are very, very busy on all the corporate advisory activity. Okay, and that happened in some of the discussion in Taiwan, as well as looking at also diversifying their portfolio, because out in the region, we have US dollar is the reference currency. So again, we are looking at both diversifying the currency, diversifying the asset classes into different asset classes like alternative or commodity. So gold is getting very popular.
Okay.
And also looking at NTD, what are they going to do there? And then also looking at succession planning, and met a few of the next gen who are now in the picture running the family. So then the topic like setting up of the family office and also learning how to diversify is.
So is that the theme now, to diversify away from dollar and dollar-denominated assets? And where to?
I mean, into other asset classes like even crypto, gold, and also looking at other currency. Because as I said, bulk of our clients, almost 100%, if not 90, 100% are in dollar. So looking at also some other currency. And in the past, it's also quite US-centric.
Yeah.
So I've been also observing and and witness some of the diversification out of the US portfolio, 23% to Hong Kong, China. And I mean, you all know, in the last few years, it was a very difficult year and market in China, in Hong Kong. Whenever we talk about China, they almost want to shut me off. Don't talk about China. But now, in recent months, going into some of the international conferences, they will ask me proactively, Amy, what are some of the investment opportunity in China?
Market opens are coming up next in Sydney, Seoul and Tokyo. This is Bloomberg.
This is the Asia Trade. We're counting down to Asia's major market opens, and we'll be watching the semiconductor space. Haidi, now Nvidia and AMD getting those sales to the Saudi Arabian AI company. Not to mention that President Trump is touting $1 trillion of investments from Saudi Arabia. Not to mention that his administration is potentially getting a plane from Qatar.
A lot of questions over that. Also some questions over that $1 trillion number, right, and how that sort of adds up. We'll be digging a little bit deeper into these deals and agreements and commitments that have been made. But certainly we're still seeing really that reaction to the de-escalation when it comes to US-China trade, and also that softer than expected inflation print, with the question of, when are we going to start seeing the impact of these tariffs kick in?
Yeah, take a look at how we're setting up with the Japanese markets right now, because we are seeing the yen holding at that 147 level against the US dollar. We had a little bit of strengthening overnight, given that that US dollar rebound that we saw in the previous session was not really maintained, faded a little bit in the past session. We'll be watching the topics right now holding at that 2770 level, because we have seen 13 sessions of gains for the topics already. If we actually go up for another day for a 14th consecutive session, that would be the longest winning streak since 1988. Right now, under a little bit of pressure, we are reacting, of course, to a lot of the earnings coming out. We saw Sony earnings that we're going to get later today. SoftBank profit more than doubling. We are also getting some earnings from banks as well later today. Take a look at how the Kospi is also setting up. Of course, the Korean won has stayed at around that 1400 level. The Kosdaq under a little bit of pressure, with the Kospi gaining 0.6%. We saw the jobless rate falling a little bit more than economists had expected, coming in at 2.7%, Heidi.
Take a look at how we're setting up. Of course, it is a staggered session to try and get a read on here in Sydney, but futures were looking pretty positive. We're just getting online a little bit flat at the moment, so giving that a little bit of time. Certainly one to watch will be Macquarie. We've had this focus when it comes to the regulatory action from ASIC there, so that would be one of the big questions as we get into the trading for Macquarie Securities. In particular, we are seeing the Aussie dollar on the front foot, 64.73, amidst a bit of a softening in the greenback in reaction to the US CPI number and the pushing back of these Fed rate cut expectations, I should say, through to the end of the year, and taking a look at the reaction across treasuries as well. I should mention oil, which is taking a bit of a breather after that 4-day rally that we saw, Shery.
Haidi, Citadel founder Ken Griffin says holding cash would have been the best way to navigate the recent market volatility. He also told us exclusively that President Trump should focus on keeping inflation at bay.
Ultimately, any effort to force manufacturing back onshore into the United States is going to be inflationary. There's no doubt about it. And what frustrates me on this is that one of the reasons that Trump won the election was the American people had had enough inflation. They wanted a break from seeing their standard of living deteriorated by the ever-increasing price of goods and services. And so I really do think that the president needs to think long and hard about the necessity of helping to protect the standard of living of the American people by keeping the inflation, like, it's not a genie, it's like the inflation devil in the bottle.
So what does this mean for Fed Chair Powell? How difficult does this dynamic make his job, and do you think his job is secure through May of 2026? I
got to tell you, I'm really happy not to have his job. Like, he is the biggest no-win job in the country, because through the lens of hindsight, we will always be able to second-guess every single decision he makes. Right here, right now, he's grappling with, do you cut rates as the labor market shows ever so slightly signs of softening, or do you hold the course because of the risk of an inflationary spike coming from tariff increases? He's going to have to make that decision based upon evolving policies over the weeks ahead. It's a really tough predicament he's in right here, right now.
Ken, it sounds like you have doubts that the American economy can be easily transitioned into a manufacturing one. What are the chances of making that work? And do you think that it's a realistic goal?
I mean, look, there's a great video clip from Dave Chappelle, and it goes something like, Americans want to wear Nikes, not make Nikes. And I think he's spot on. I don't understand why we think it's a virtue to bring back to America low-skilled jobs in manufacturing. I completely agree with the president. We need the ability to ramp up our manufacturing base to strengthen our national defense. Spot on right. But I don't think the American people are looking for a return to low-skill, low-paying manufacturing jobs in our country. I don't think they want those jobs. I think they want jobs where we are building high-value-added products, successful businesses building high-value-added products where you can create jobs in that factory floor that are well-paying jobs. Those are the jobs we should aspire to create in our country, not jobs that right now China is actually trying to move to other, even lower-cost labor countries. Why do we want those jobs here in America?
I'd love to see this from your position leading Citadel, and also your message to Citadel Securities employees. What do you tell them to navigate all of this volatility?
So I will tell you that for my portfolio managers, it has been several really challenging weeks, because every couple of days there's another big headline on Bloomberg that we need to react to, and we need to reshape our portfolios with respect to. It's been a really difficult time for fundamental investors, because so much of the value of the companies that we invest in is being dictated by very quickly changing policies from Washington.
So your best way to navigate that?
I think in retrospect, perhaps holding cash would have been the best way to navigate this, but that's so contrary to our culture of always trying to be on the offense, always trying to find ways to create value in the markets.
Is there something fundamental that's changing about the way you approach markets?
Look, I fundamentally believe that this period of instability that we're going through will come and go. Like, fundamentally, I believe that as the Trump administration moves through time, as policies become solidified, the economic backdrop against which one invests capital will become easier once again.
Citadel founder Ken Griffin speaking with Sonali Basak for Bloomberg Original's upcoming series, Bullish. Let's now head over to Hong Kong, where the Macquarie Asia Conference begins this morning. Christina Lee is Macquarie Capital Senior Managing Director and Head of Asia Research and Sales. Christina, really good to have you with us. Of course, we are now seeing a little bit of a cautious early morning session across Asia, despite the fact that we had that thawing of tensions between the U.S. and China. How much longer do you expect the risk rally, the sort of optimism over these trade deals to last when it comes to risk assets?
I think it's interesting times, certainly. But what we try to do at Macquarie is really to look through this day-to-day noise and the volatility. And, our conference, for example, is really about how the investors can really push their curious minds to think about what could fundamentally change our lives in coming years and perhaps even decades. So, yes, there's volatility in the market, but we try to look through it, really.
Will that volatility in the markets also lead to more investors focusing on the Asian markets and trying to find value at a time when there's so much uncertainty with U.S. policy?
Yes, I think Asian markets, what's going to be very interesting to watch, in my view, for this year especially, is that last decade, the capital flow has been very much one directional. A lot of it just went to the U.S. for various reasons, which made Asian markets actually relatively attractive in the valuations. And if you look at the recent sort of numbers, the emerging markets still had an outflow in the first quarter of this year, given the volatility and the uncertainties. But we are now at the stage where the market's almost oversold based on the historical numbers that we can look at. And this is a great opportunity for investors to have another look at Asia. And there are numerous opportunities around the whole region in our view.
And China is one of those places where you see those opportunities, not just domestically, but also for some of these US companies that have exposure there.
Yes, I think it's going to be very interesting, the opportunity, because any sort of volatility and the disruption can actually generate opportunities for those who will take on the challenges and try to think about the opportunities. And at this juncture, I think a lot of Asian companies can really push themselves on the next level of innovation, and that makes active investing very interesting for the equity investors today.
What is your broader sort of business strategy then, given the oscillating baseline expectations when it comes to trade, geopolitics, and how it impacts individual economies?
I think the Asia as a region, the trade, the tariff situation, and all this noise, as I mentioned before, it is really about the disruption. And we do say that what happened the last couple of days is perhaps this is the not necessarily the end of the beginning. It is more like the beginning of the end. So it will still take time, and we will all have to get used to hearing more about this in coming months and perhaps years. And it's really up to how the individual economies to navigate that. But what's very exciting about Asia is that I think the region is really ready to push for the verticals and ecosystem and the thematics cross-border, not just each of the countries. And that's where Macquarie Research is really trying to focus on.
Right, Christina Lee, Senior Managing Director and Head of Asia Research and Sales at Macquarie Capital. Good to have you with us. Take a look at some of those stocks that we're watching in the Asian session today, especially with Nissan coming out with its biggest annual loss since 1999. You can see a downside pressure of about 2% on the stock. We heard that they'll be closing 7 factories and cutting 20,000 jobs. We're also watching Honda. They expect a 450 billion yen hit to their full-year profit due to President Trump's auto tariffs. Of course, we are seeing other automakers also tallying the tariff impact at this point. Take a look at what SoftBank is doing right now, because their profits soared 124%. We saw increased valuations of tech startups like ByteDance and Didi. You can see the stock gaining more than 5%. SoftBank reaffirming those plans to invest up to $30 billion in ChatGPT owner OpenAI. Also, given that we're talking about AI, take a look at these semiconductor names across Asia. Of course, we have seen Nvidia and AMD supplying the semiconductors to that Saudi Arabian AI company that results from President Trump visiting Saudi Arabia. At the same time, we know that the Trump administration is really refashioning those regulations around AI chip exports, Haidi.
We're also watching Insignia at the moment, with Bain dropping their takeover bid. The CC Capital talks are continuing, though. We're seeing Insignia off by quite a significant magnitude at this point. The takeover offer for the Australian wealth firm has been dropped by Bain Capital, but talks are continuing with the remaining bidder, which is CC Capital Partners. Bain telling Insignia that it won't be proceeding with a binding offer due to, quote, macro uncertainty caused by the volatility in global capital markets, according to that statement. The CC Capital bid, though, the deal that is actively working towards making a binding bid in the coming weeks. We had seen both firms making separate cash offers at $5 Aussie per share. That's a value of about $2.2 billion for the company. We closed at $4 for Insignia in the Tuesday session. So very interesting now that we're seeing CC Capital as the only live bidder here. Clearly, M&A activity globally being impacted by a lot of things, including the uncertainty over global trade and market volatility. This is Bloomberg.
President Trump and Saudi Crown Prince Mohammed bin Salman have announced big investment pledges at their summit. Although the exact value of the deal isn't necessarily clear, for more, let's bring in Bloomberg News editor Jill Deasy. We're seeing huge upside when it comes to the semiconductor sector because of those sales that could come for Nvidia and AMD. But what exactly do we get in terms of other more concrete investments?
Yeah, that's right, Shery. Well, I think that, obviously there's all this focus on the Nvidia AMD deals because we've actually seen, some more tangible explanations of, those companies supplying semiconductors to these Saudi Arabian projects valued at about $10 billion. In terms of the overall scope of what Trump and MBS are really talking about here, I mean, you have to first of all remember that, Trump's foreign policy language, his diplomacy language is really just about deal making. So I think if he can kind of come in to the region, make a big splash by, it's doing this joint announcement where they say that these, deals are worth $1 trillion. Obviously, how much of that is really rhetoric versus how much of that is concrete deals? I mean, that's really, that's such a massive number. You're essentially looking at the size of Saudi Arabia's economic output here. If you were to kind of look around the venue where they had this investment forum, the total value of deals kind of came to around $300 billion. White House is citing a figure closer to $600 billion. I mean, it's a few $100 billion between friends here and there. But really, again, I think that the point here to kind of look at is, look, Trump is in the region. He's, wants to obviously project this image of stability, and he wants to kind of put the, United States forward as a force for that kind of stability. But at the same time, he also sees foreign investment into the United States to be a really key driver of fostering a lot of those relationships. So for him, it becomes a lot more about investment in economics. So I think that if he can kind of get up on stage and say, we're doing all these things to create deals to, sort of facilitate more Saudi foreign direct investment in the United States, that seems to be a win for Trump then.
Yeah, and the policy message seems very transactional, right, when it comes to, we strike these deals, we have this good economic relationship, and there won't be any pushback when it comes to other topics like human rights. What sort of geopolitical tone was struck, and what are the implications from, from some of the other sort of critical talks and scenarios that we're seeing across the Middle East?
Well, I think that at this point, what you saw in Trump's policy speech there was essentially this message of, work with us and we'll stay out of your affairs. So that's kind of, it seems, the message that Trump really wants to project here. He did vow to lift sanctions on Syria, obviously in the wake of Assad's fall last year. I think, that's something that he also had said he was motivated to meet with the Syrian leader because of some conversations on the sidelines here with MBS. So again, I think that does show you that what Trump, really wants to kind of project is that, the United States is capable of, sort of being this moderating force in the United States. But at the same time, again, as you said, a lot of his deals are very transactional. A lot of his relationships are very transactional. And so if he can come in and say, look, invest in our country, then, we'll kind of let you do, a bit of what you want to do. That, again, seems to be the message here. We'll obviously have to see how the rest of his Middle East trip goes. But I think at this point, a lot of the really interesting lines that have come out of this, I think, are much more centered on some of those more interesting tech deals, including, obviously, what you're seeing with the supplying of semiconductors from Nvidia and AMD to, the Saudi Arabian firm backed by, sort of the state fund. So I think that that's the kind of stuff that I think is, really, really worth keeping an eye on, definitely over the next few weeks.
Bloomberg News editor Jill D says they're watching Aramco, not least of which is, of course, because they've been touting this massive $3.4 billion US refinery plan during that Trump Middle East visit. But we're also seeing a potential deal when it comes to Woodside Energy and Aramco this morning as well, entering into a non-binding collaboration agreement to explore global opportunities. This includes a potential acquisition of an equity interest in an LNG offtake from the Louisiana LNG project for Aramco. So they're looking at a potential collaboration when it comes to lower carbon ammonia. That deal was signed in Riyadh at that Saudi-US investment forum. Well, China is said to have removed a month-long ban on airlines taking delivery of Boeing planes following a breakthrough in trade talks with the US. For more, let's bring our executive editor for the Greater China region, John Liu. So, more sort of, overtures in the broader context of the de-escalation here.
Well, we've been waiting for news about what would happen to these Boeing planes after the Trump administration put on the tariffs on Liberation Day. The Chinese government asked its airlines to stop taking deliveries from Boeing. In Geneva, in addition to the de-escalation, the lowering of tariffs, China agreed to remove non-tariff barriers that have been imposed since April 2nd. This was one of the biggest ones. It's very important to Boeing. Boeing's got about 50 planes it's hoping to deliver to Chinese carriers this year. China has about 20% of global demand for jets over the next 2 decades. And so Boeing's ability to export to China is going to do a lot in terms of lowering the trade deficit the United States has with China. And it's going to be a really big indication of whether or not businesses, multinationals, can get back to what they're good at.
And President Xi Jinping also busy when it comes to the diplomatic front. He's been hosting Brazilian President Lula, and they have dozens of agreements when it comes to the economic front. Tell us a little bit about the nuances of this relationship as we continue to see the rivalry between Washington and Beijing.
Well, as a result of a lot of the trade actions that the United States has taken since President Trump took office, it's opened up this opportunity for China on the diplomatic front. China is portraying itself as the responsible player on the global stage. It's portrayed itself as the defender of free trade around the world. And it has very different economic relationships with countries like Brazil, other countries in Latin America, than it does with the United States. China has a trade deficit with Brazil. It imports lots of agricultural goods. It's investing in Brazil. And so this is a very important economic relationship for China. It's given the trade relationship, the trade tensions with the United States that many countries have given China an opportunity to strengthen those relationships. And it's important because if trade with the United States was going to get more difficult, China was looking for other markets where it could send its goods.
So much John Liu there with the latest on China and, of course, all of its diplomatic efforts around the world. We have more ahead. This is Bloomberg. This is the Asia Trade. Here are some of the stories that we're following at this hour. President Trump says he will lift U.S. sanctions against Syria following the toppling of former President Bashar al-Assad. The move will provide a significant boost for Syria's new president, whose Islamist rebel group overthrew Assad's regime in December. Trump says his recent discussions with Saudi's Crown Prince and Turkey's president persuaded him to make the move. Israeli Prime Minister Benjamin Netanyahu says he's days away from ordering an all-out escalation of Israel's war against Hamas. Netanyahu says his armed forces are preparing to, quote, finish the job after 19 months of attacks on Gaza. Hamas this week released the last surviving U.S.-Israeli hostage, but still holds 58 Israelis, with fewer than half believed to be alive. India has proposed levies on some U.S. goods in response to Washington's duties on steel and aluminum. The Modi government told the World Trade Organization the U.S. metals tariffs adversely impact India's trade, and it has a right to suspend concessions as a countermeasure. This marks India's first retaliatory action against President Trump's tariff regime and comes as the two countries negotiate a trade deal.
Take a look, Shery, at how futures in Europe are opening up at the moment. As there's been really caution dominating the start of trading here in Asia. European stocks in the previous session held pretty steady there, with still a lot of question marks when it comes to where next for the trade picture, particularly developments as to whether the recent rebound that we've seen in European equities is sustainable. Stocks 50 futures looking pretty flat at the moment, about 0.25% to the downside. A little bit of softness for German DAX futures, which of course have been an outperforming market, and the euro on the front foot with that weakening of the US dollar following the US CPI print. Really looking at whether the de-escalation between US and China will have some of the disinflationary pressures on Europe, as well as a path ahead for its own negotiations. This is Bloomberg.
Take a look on how automakers are trading early in the Asia session right now, really reversing those gains that we saw in the previous session on that risk-on rally across Japan. Nissan losing about 3% at the moment is really leading those declines in Japanese automakers. The company reported a full-year net loss of $4.5 billion, its biggest annual loss in 25 years. It's accelerating its restructuring plans after those results. It's closing 7 factories, cutting 20,000 jobs. Let's bring in our automotive reporter, Nicholas Takahashi. Nick, so they've tried for a very long time to have a turnaround. So what's different this time?
Well, so when CEO Ivan Espinosa spoke to the press yesterday, it was his first call since taking the helm. And what you just described was a major departure from the plan outlined by his predecessor, Makoto Uchida, in November. Back then, Uchida said that Nissan was planning to cut 9,000 jobs and 20% of production capacity. Yesterday, Espinosa told us that that number would be more like 20,000 and that the company was going to close 7 plants globally. And so, you know, the expectation has been that Nissan, or the hope has been that Nissan will face reality and sort of recognize the depth of its crisis. And I think Espinosa's plan yesterday was an attempt to reflect that level of concern. But now we're seeing, just a few minutes ago, the market opened and Nissan shares are down about 3%. And so whether that's you know, that plan was convincing enough for shareholders, I think the truth is in the numbers.
Did Honda do any better?
In a way, yes. In another way, it's facing most of the same challenges faced by Nissan. U.S. tariffs on cars and imported parts are bad news for most global car makers. And in Honda's case, it's forecasting a $3 billion USD drop during the fiscal year, which is very significant. And throughout the rest of the year, it's going to be spending big on efforts to mitigate the impacts of harsh duties.
And you really can't blame these automakers, right? There's so much uncertainty out there. Mazda, I think, earlier this week didn't even provide a guidance, because how can you when you really don't know where these tariffs are going? What's the state and health of the broader Japanese auto industry?
Well, I think you just summed it up. Mazda and Nissan withheld their forecast for the fiscal year. Honda and Nissan both projected a $3 billion hit to their bottom line. I think Ford was around 1.5 billion and General Motors around 5 billion. Toyota, in fact, actually, just for the months of April and May, forecast an impact of $1.2 billion. And so across the board for all global car makers, when it comes to their footprint in the U.S., they're expecting big hits to their annual profit.
Bloomberg automotive reporter Nick Takahashi with me here in the Tokyo studio. Thanks for that again. And take a look at how SoftBank is doing, because this is one stock that's actually seeing a rosier day today. Their profit soared 124%. You see the stock gaining more than 5%. It's the fourth consecutive session of gains for SoftBank that has seen increased valuations of tech startups like ByteDance and Didi. So they reaffirmed plans to invest up to $30 billion in OpenAI. They're also moving forward with their Stargate project to deploy that $100 billion into data centers and other infrastructure. Of course, we have seen some reporting lately that those investments have slowed down, though, Haidi.
Yeah, it is a big week for tech, right? Because investors also closely watching earnings reports from the likes of Tencent, Alibaba for clues on the health of China's tech sector, the potential for growth and really the underlying fundamentals for this tech rally. Bloomberg's executive editor for global technology, Tom Giles, joins us now from Hong Kong for today, which is great to have you in the region, Tom. So let's start off with Tencent, of course, such a pillar when it comes to these expectations. We know that we'll be watching the AI side of the business. That's unlikely to be a meaningful contributor to these earnings yet, though.
That's right. Analysts from Bloomberg Intelligence say that AI is really not going to filter through in a meaningful way for Tencent. Where Tencent is going to be benefiting in today's results, and we're going to look at double-digit revenue growth for them. That's what's expected. That's going to come from their exposure to a broad cross-section of the Chinese economy. Remember, they're in gaming, social media, WeChat, across the board. They are in your everyday life in so many different ways. So when you look at the Chinese government and its stimulus, you look at the fact that the big tech leaders in China have been really shielded from the trade tension. That's where Tencent is really going to be benefiting.
And it seems that we already saw those benefits for JD.com as well, given, of course, Beijing's support of the broader economy.
That's right. Stimulus is a word that just keeps coming up time and time again when you look at how the Chinese big tech companies are performing. And now that you see a little bit of alleviation of the trade tension between the U.S. and China, even though they had been shielded, as I said, any concerns that the big trade war would maybe lead to a slowdown in the Chinese economy, which would have a knock-on effect for all of these big players, that is starting to dissipate. The other thing to watch with JD is their their entry into the hyper-competitive ride-sharing and food delivery business, where Meituan is very much the leader. They're the giant here. They're the one to beat. And JD is vowing to go after them with a vengeance. The thing that investors are concerned about, though, is obviously how much you have to spend, those coupons that they're handing out, their efforts to get loyal customers to join their ranks. And remember, these are razor-thin margins. And if you call up a chart of JD's margins compared with the other big tech leaders in China, they're much smaller. So JD's going to have to show investors that they can move into this food delivery and do it in a profitable way.
As Shery mentioned earlier, one of the big headlines coming from Trump's visit to the Middle East is really opening up these floodgates of broader AI chip access for Saudi Arabia and the broader region. What are the implications of this, both obviously for the likes of Nvidia and AMD, but also some of the geopolitical implications, given there are still concerns that it could end up in the hands of China?
That's right. What he's doing is paving the way for there to be a much bigger flood of chips coming from the likes of Nvidia. Under the Biden administration, the previous president in the U.S., there had been limits, there had been concerns, and there were strict limits on how many chips Nvidia could sell into the Middle East. As you said, there's this geopolitical concern about where do they go from there. Does the U.S. have a close enough relationship with Saudi and these other places to keep them in its sphere of influence and out of China's. That's been a big concern, a big question. And that's what Trump is doing there right now as we speak, is trying to make sure, look, we're friendly, we're going to reduce and eliminate some of these restrictions on chip sales to you. In return, stay loyal to us and keep very close tabs on where these chips end up. We don't want them benefiting China's military in particular.
But all of this coming at a time when we have seen, of course, a rise of DeepSeek and potentially cheaper AI models, right? You're in Hong Kong right now, Tom. Give us a sense of where these advances in technological developments by China have gone so far, and how this refashioning of Biden-era chip export rules could change that.
Yeah, there remains genuine concerns in the U.S., in the West, about how advanced China is in artificial intelligence. As we all know, up until late last year, there was a presumption and a little bit of, frankly, hubris, I would say, in different parts of the U.S. about, well, China's really good at facial recognition, voice recognition, but not so good at this generative AI thing, where the United States has sprinted ahead with the likes of OpenAI, Anthropic, for example. But DeepSeek caught a lot of people by surprise. It showed that, hey, these companies in China are really good at this, and as far as we can tell, they're doing it a lot more cheaply. And so now you have Manus as well, another player in this space. And I think that you're going to see a lot of attention being shifted to China and its generative artificial intelligence capabilities. And can they do it more cheaply, more efficiently? And all these tens and hundreds of billions of dollars that we're investing in data centers, do we really need to be investing that much? Or do we need to start scaling that back and learn from the way the Chinese are doing it? There's still a lot of questions about how efficient it is. There's still a lot of questions about how transparent these companies are being with exactly how they get the chips to be as efficient as they are. But as soon as we get the answers to those questions, the U.S. companies are going to be watching very, very closely and figuring out, do we need to be investing as much as we do? For the time being, it looks like the picture is very bullish for these data center investments, for these chip investments. Nvidia, we just talked about its ability to sell into the Middle East. And as of now, we see tremendous demand for the chips made by Nvidia, ARM, and of course manufactured right here in our backyard by TSMC in Taiwan.
Right. Tom Giles, Bloomberg's executive editor for technology. Really good to have you in the region as we continue to watch the tech sector. We'll be watching Hon Hai in Taiwan. We're expecting their first quarter earnings to come out today. Analysts expecting strong profit growth for the main contract manufacturer for Nvidia AI servers and Apple iPhones. Last month, it reported strong revenue thanks to pull-in sales triggered by U.S. tariff concerns. Investors will be focused on how the company is navigating the geopolitical uncertainties and its move to increase its manufacturing footprint in the U.S. Still ahead, we're back live at the Macquarie Asia Conference in Hong Kong, speaking with Pony.ai about their growth strategy and robotaxi plans. That's exclusive conversation next. This is Bloomberg.
Chinese EV tech company Pony.ai has announced a partnership with Uber last week aimed at deploying its robotaxis on the ride-hailing platform. The goal is to launch in a key Middle East market later this year. Let's go back to the Macquarie Asia Conference in Hong Kong and bring in Pony.ai CFO Leo Haojun Wang. Leo, great to have you with us. So let me start off with that collaboration with Uber. Can you give us more details in terms of which markets you're prioritizing, where and when we're going to see that launch, and really the business opportunities that you see from this deal?
Great to have this opportunity to talk to you guys. Yes, so you already see our deal with Uber. Actually, it underscores our strategy to scaling up. At the end of last year, we have about 250 robotaxis primarily running in China, and our strategy is to scaling up. Just about 2 weeks ago, we debuted our 7th generation robotaxi in the Shanghai Auto Show. And we will deploy these robotaxis, new robotaxis, in China first, but also including the global market. So when we are exploring global market, definitely we're looking into the market where would have strong mobility demand, welcome regulation framework, and also strong partnership. So Uber will be one of our preferred partners to exploring these global markets. We are planning to launch a robotaxi with Uber in Middle East first in this year. So I would say definitely you will see more and more Pony robotaxis running in China and other global market in the coming quarters.
When Bloomberg spoke with James Peng, your CEO, in April, he was concerned about the impact of global tariffs and certainly US-China trade war implications on your business. Now that that relationship seems to be warming, do you see more opportunities in the US market for Pony.ai?
I think globally there's a huge market for robotaxi for sure. And as a startup, we have always been agile and closely monitoring all things happening, including the capital market, including the geopolitical area. So as of right now, I think our primary goal will be in China and also in other global markets, but not for the US at the moment.
Why is that? Are you seeing greater scrutiny in the U.S.? How's that business unfolding right now?
So as far as the U.S. market, for sure, it's a very big market. But if you look at the global scale, for China market, other global market, that will be huge. And also for a startup, we need to expand our business pace by pace. And what's our best case to show up our technology and business viable? So I think China probably will be the first one for us to stand out and prove us in the leading position in this robotaxi. And later we can expand into more markets. That's our strategy.
When it comes to business viability, when do you expect to break even or even turn profitable?
I think that's a very great question. And also that's why we're rolling out the 7th gen robotaxis, because these new robotaxis are so cost effective. We believe with these new robotaxis, we can prove, first of all, on the UE level, they will have a very good UE economics, break even, even making some profits. So once we have this proved, for sure we'll quickly scaling up with these new robotaxis. And with our large fleet of our new robotaxis, that definitely will support the company to break even. So that's our path towards viability.
How quickly can you scale up when it comes to this WeChat deal? And is the goal for profitability still 2028, 2029? Do you have a date or a year in mind? Has that changed?
So I believe definitely the scale up will coming from like hundreds at the end of last year towards thousands and then tens of thousands. That's the path we'll take. For sure, this scaling up definitely will take a few years. So we do have, like James previously mentioned, probably like around 22 to 28. That's our target to break even for the company.
Leo, you mentioned, of course, the positive view of what can happen with your China business, but at the same time, because of increasing economic pressures in China, not to mention, of course, the growing competition as well. What are your prospects and the challenges that you could face headed towards that goal of profitability by 28 or 29?
So, well, definitely there is up and down in China's economic. But as you can look, in terms of mobility service, China is still the biggest one. And also the demand in mobility service is still very, very strong. That's why we do see, in terms of the total addressable market, especially in China. That's still very, very huge. And for that huge market, for a company like Pony to make commercial viable, it only needs a small percentage in the mobility service. Then we can still achieve that goal. And not to mention, we are also targeting at other global markets. So I think the room for us to grow and make commercial viable is very huge.
Leo, thank you so much for spending time with us. Haojun Wang, CFO at Pony.ai. We have more ahead. This is Bloomberg. An executive with Morgan Stanley's Asia private wealth management business says the U.S.-China trade truce has set the scene for a rebound of stocks on Wall Street and an imminent repositioning in China. Christina Au-Yeung told us the U.S. still has the highest quality market despite tariff tensions.
The conversation about U.S. exceptionalism and the challenge to U.S. exceptionalism has very often been associated with the Magnificent Seven. And the Magnificent Seven, as much as that leadership in the US has been driven by the large cap or mega cap stocks, it's not synonymous with US exceptionalism. US is still the deepest and highest quality market. There are many areas within the US to traffic that are very interesting. There is still significant innovation coming out of the US. And if anything, yes, we had experienced higher levels of valuations that were necessarily comfortable for clients to be getting into with fresh money. Now we've seen that retrace a little bit and actually setting a healthy scene to get back into some of these interesting names.
As it retraces, though, and maybe some funds flow away from the US, where do they go into? What are you advising clients?
So on the other side of the US is actually what we've seen now in China. We're seeing an emergence of really interesting themes coming back out in China. We're seeing that China is emerging from being the world's factory, from making and manufacturing products for everybody else and servicing everybody else, to actually becoming a global leading innovator in its own right. And opening and paving the way for repositioning in China. Valuations are not demanding. We've seen significant investment in R&D, talent, capabilities, their own supply chain, and we're actually very interested in and excited about the opportunity set in China.
What's the right proportion, though, to allocate to that market?
So in terms of global asset allocation, our investment committee is recommending something like a 40-40-15 split between fixed income, equities, and alternatives, with the balance in cash and cash equivalents. Now, rather than allocating to specific markets, it has become increasingly important to have a globally diversified portfolio to navigate through that volatility. This is why we have seen alternatives take up an increasingly important role, a core function in client portfolios. Now, a 40-40-15 model is designed to help an ultra-high net worth client with a balanced growth objective achieve something like a 7 to 8% total return over a 7 to 10 year horizon, but with about the same degree of volatility. Now, if I set the scene in terms of what that means, achieving 7 to 8% returns per annum with about the same volatility in an environment where volatility is elevated is significantly harder work than, say, in post-GFC era where volatility was much lower.
Morgan Stanley Private Wealth Management Executive Christina Au-Yeung there, speaking to Annabelle Jewellers at our New Voices event in Hong Kong. One of the stocks we're watching here in Australia is CBA, Australia's biggest lender, seeing profit just edging up amid some growth when it comes to the business loans part of the business. Transactions up 7%, business lending also expanding faster than what we're seeing across the broader market. Also some commentary when it comes to the global economic risks, with the CEO Matt Comyn noting that heightened heightened risk to the global economy from geopolitical as well as macroeconomic uncertainty, but did say that Australia is in a relatively strong position to be able to navigate those challenges. So that really capping off a round of bank updates on Wednesday. Both cash net profit after tax in the third quarter up by 6%, and the unaudited result coming in pretty flat when it compares to the first half that we saw. Take a look at how futures are setting up for the rest of the trading session. Pretty muted when it comes to S&P futures, but some upside expected for Taiwan.